Hello and welcome to the Fat Tailed Thoughts podcast. I'm your co-host as always, Stephen Dickens, and I'm joined by Jared Clee. Hey Jared, welcome to the show.
Hey, Steven, how are
Not
you?
too bad. We've got some company for those of you watching on YouTube. The dog has decided to sit on the couch and look all regal behind me. So whether she stays for the whole show or not, I don't know. Maybe that depends on how funny and engaging we are, Jared.
If she wants to jump in and add to the discussion, more than happy to take her opinion on any one of the topics
Well, I think
today.
she's probably more qualified to talk about the workings of finance, fintech, crypto, and money than maybe the two of us combined, but we'll just blow straight past that. So, episode 25. Yes, we've been doing this for almost half a year now, which is kind of crazy. This week we're talking about credit card payments and payments in general. Topic that's dear to my heart. I've written on this in the past. I know you're an expert in this space. Let's get the listeners orientated here. What are we going to cover?
There's a revolution going on, Steven. Let's just rewind the clock a little bit. Visa is a tremendous success story, kicks off. We go back, Visa in 1976. We go a few years before that, it was the Bank of Americard. It's a story I've written about previously, but the evolution of credit card payments, it's awesome history there. We're kind of skirting over it. But basically, you get to 1976, Visa gets launched as a bank consortium. And that's basically it. I mean, we have had that payment infrastructure for 50 years. Now, MasterCard's emerged since then as a competitor. American Express emerged with a competing system of the parties involved. Discover, which used to be Diner's Card, has since emerged. But fundamentally, the basics of how we do payments has not changed. And all of a sudden, with cryptocurrency, ignore the crypto side. We now have ways of processing dollar payments across cryptocurrency rails, meaning across the cryptocurrency networks for practically nothing.
And that's the
That is a
that's the key
major
distinction.
challenge to the credit card
And that's the
networks.
key distinction here. And you touched on it, but just for the listeners, I'll get you to double click. We're not talking about using my Bitcoin to go and buy something. We're not. Oh, the dog's moving now. Whether this is a good or a bad thing, she's getting comfortable. We're not talking about using Bitcoin as a form of payment here and using a Bitcoin denominated card or a Bitcoin denominated payments network. What you're saying here is using the underlying level one and layer one and layer two networks that are available in the Bitcoin space as a replacement for the Visa network. So this would still be, I'm buying my Starbucks for $5. It's denominated in $5 in dollars. It's really just the network that $5 gets moved around on. Maybe just expand there to it, because I think this is key before we kind of get into the rest of the discussion.
That's exactly right. It's why I call it a revolution. So, you and I, any of our listeners, when we go to Starbucks or the corner coffee store or what have you, we don't care about the network under the covers, other than the fact that we got a piece of plastic, we can swipe that thing, it pays for the thing we're buying, and hopefully we get some reward points or cash back or miles or whatever it is. But frankly, we don't really care that it moves across a Visa network or an Amex network or a MasterCard network. And to be clear, these are all proprietary networks, wholly owned by the companies that run them, and they don't talk to each other. They're islands unto themselves. What we're talking about with crypto is the ability to keep swiping your card, tap your card, pay for things in the same dollars you use today, but moving across an open source network that, because it's open source, maintained by millions of people, it's basically free to use. That is it's moving the goalposts on what a network can be, and that poses a real challenge, a totally different type of challenge than the credit card networks have ever seen before.
Well, previously the challenge was VisaNet first, Mastercard comes in. You've now taken a single approach, put two players in the market. Amex comes in, Discover comes in, what used to be Diners. So you've gone from 4 people all using roughly the same technology stack, roughly the same approach, just different incentive structures and different network effects. Now we're talking about a fundamental pivot to a different underlying technology stack. And your point is we're going from a centralized technology stack provided by Visa, MasterCard, Discover, or Amex to a decentralized technology stack provided by a crowd of people who run nodes in wherever they want to run nodes, basically.
Precisely. Let's just talk about the economics. Why is this interesting? Well, the answer is if Visa and just by the way, for the conversation here, I'm gonna keep coming back to Visa. This isn't just it's not just Visa, it's all of the big card networks. Visa by transaction value rather, last year was more than the other three networks combined. Is bigger than MasterCard and Amex and Discover. So I'm gonna keep talking about Visa because they're the giant in the room, but this applies equally across. So if I go to my corner Joe's Coffee up here, Joe's is gonna sell me a called a $3 cup of coffee. We're gonna make the math a bit easy. They're gonna sell me a $3 cup of coffee. Off that $3 cup, they're gonna make about 19 cents. That's after paying for the beans, that's after paying the employees, that's after paying for the real estate. They're gonna make about 19 cents on that cup. Now, using a credit card isn't free. It's free for you and me as long as we pay our bills, but it's not free for the store. Rather, the store is going to pay on average 10 cents plus 2% of the transaction value. So you think when they swipe that card, if they just paid it straight to Visa, that's 10 cents plus 2% of $3, it's 16 cents. But the story gets worse. There's a payment processor, that Square terminal or Toast or whatever it is they use to process takes a cut on top of that. In Square's case, it's another 0.6%. So right off the top line, if you do that, it's 10 cents plus 2.6%. The coffee shop is giving up 18 cents off the top line. The only net 19 cents a cup. Basically, if I could give that back to them, if I paid cash, for instance, I double their profit on every single coffee. So the question is, why doesn't a coffee shop do that? Well, Variety Coffee just moved in directly across the street from them, kitty corner. If Joe's Coffee stops accepting credit cards, you can be damn well sure I'm going to Variety Coffee. I like paying with my credit card. I like getting my 2% cash back. Half the time, I forget to bring my wallet and I simply pay by tapping my phone, which has my credit card on it. Well, I can't do that if Joe says we're only taking cash. So they keep taking credit cards despite the amount of profit they're giving up. So what a merchant is looking for in this scenario is that same stack, that same user experience of come in, swipe a card, tap your card, pay any way you want, but they want to take way more profit at the bottom line. And that means you have to stick something else in between, a different network other than the Visa, Amex, etc. that they're using today.
And this is why we see for small transactions, you may see in the gas station, we don't accept credit cards for under $5. There's some stores have minimum limits because the profit that they make on that small transaction when you buy a pack of chips or you buy a can of soda or whatever. Everything. See how American I've become. I didn't say crisps or can of pop. I've become so American here. But for those small transactions, there's just not enough profit in the transaction to cover the base fees. Might be only a percentage of the fee, but the upfront merchant fee to the provider and to the credit card company is just too much.
And let's be clear, we if you want really good evidence of strong lock-in, go look at what the fees have done year over year. Mastercard's fees and Visa's fees are now more than double what they were in 2012. The experience we have, we can talk about the ability to tap your phone and all the technological innovations that have happened. But fundamentally, the revenues have gone through the roof concurrent with that. The usage has gone through the roof concurrent with that. What's happening is these companies have merchants locked into the system. And they're locked in because you and I really like using credit cards. So if we really like it, merchants will keep accepting it. That means the card networks can keep ticking the fees up and up and up and up. And we're at a point now where, well, without an alternative, they'll stick on, but all of a sudden there is an alternative. There's a new way to accept payment without paying those fees. And that is a massive
And
incentive.
we've only recently seen one merchant push back against this increase in fees. There was a standoff, I don't know whether you saw it in the UK, between Amazon and I think it was MasterCard. Basically, they stared each other down. Amazon declared that they were going to stop accepting MasterCard by a date. It was pure negotiation played out on their website. Obviously, they'd got the notification that the fees were going to go up. Amazon's the biggest retailer probably in the UK, alongside maybe some of the supermarkets from a volume point of view, and they stared it down. Something happened in a smoky room, and now they're accepting the credit card. But Joe's Coffee on the Corner doesn't have the same power in this equation as an Amazon does. Probably nobody does apart from Amazon, maybe Walmart. But it's really interesting to see the dynamic. So you've basically got a cartel of these four providers who can increase prices. And especially if you're probably Visa and MasterCard, the two of them can increase prices because there's not been an alternative tech stack with a different pricing structure. That's what we're at now. And it's led by probably one of my favorite people on the internet. If you don't know, listeners, a gentleman called Jack Maulers, go check him out. He is hilarious. There could not be a more archetypal disruptor type character and the CEO of Strike. So, Jared, tell us about the revolution that Jack and others are leading to disrupt some of these payment rails.
So what we have is a massive incentives to switch over, and what we have in crypto are open source networks that don't just move messages but can move value. And that's a critical combination here. If we look at what Visa is, it solves a whole bunch of problems around fraud, it solves a bunch of problems around interconnectivity, the messaging standards of how do I communicate between banks, between merchant and bank, and so on. The crypto networks, put the cryptocurrency itself to the side. The crypto network, the Bitcoin network, the Ethereum network has those same characteristics built in. It can move value, it can move messages, it can do both in standardized, predictable ways. Critically, anybody can go hook up to them. What that means is that you can have parties that live on the network, and perhaps those parties agreed to settle their transactions between the two of them in Bitcoin, in Ethereum, in whatever they want. But they can then choose to facilitate transactions between them in any other combination of currencies they want, off on a side kind of tag along network, and you can just move it at will. And every once in a while, say every 10 days or every $500,000 or whatever, they'll net settle the transactions on the network. Now, to be clear, this is not a new invention. When you and I or our listeners, when anyone goes and travels abroad and they swipe their card and they pay in euros or pounds or yen or baht or what have you, but they live in dollars, under the covers, this process already happens today. You you convert dollars to a foreign currency, that foreign currency is used to settle the transaction. Eventually, your bank and the merchant's bank have to settle up, and they do so in dollars again. Goes dollars to foreign, foreign bounces around, eventually net settles in dollars. We're just doing the reverse here.
So this
We're
so this
going,
is the key point here, I think, and this is the difference because people will hear us say the word crypto, they'll hear us say the word Bitcoin, and they'll think we're talking about the cryptocurrency, and what we're not. And you said it a few moments ago, and I want to draw you back to it just because I think it's really foundational here. Bitcoin, the network, is different to Bitcoin, the currency. In the same way that you could use the Visa network when you travel abroad and go to France or go to the UK and do pounds or euros on the Visa network, and then when you get back home to the US, you use your same Visa card to go to Joe's Coffee and pay for your coffee in dollars. The currency is independent of the network. That is the same here with Bitcoin, the network, and particularly we need to get into layer one and layer two for a moment. Bitcoin, the network, being different to Bitcoin, the currency. And I'm kind of double clicking here. I know you said it, but I think it's foundational to draw you back to it.
It's a critical point, and what we're gonna differentiate, we'll stay focused on Bitcoin. We could have the same conversation on other cryptocurrency networks, what are called layer 2s. So layer 1 is the core network, the Bitcoin network, the Ethereum network, the Solana network, whatever. A layer 2 is a kind of tag along network that executes transactions and then commits some of the data, not all of it, some of it back to the layer one. And what that allows you to do, cryptocurrency networks are slow. They're slow because they're secure. There's a bunch of, it can be a hassle to transact on them. They can be expensive to use, but they're really good systems of record. They're very good, large distributed systems of record. Well, if you want to do transactions quickly, if you want to transact cheaply, well, you're optimizing for a different set of constraints than the layer one solved for. You still really want security and system of record type characteristics. So what you do is you take some of the transaction, you go stick it on a network that says moves quickly and it's free or almost free to use. And then you say, okay, we've moved the stuff. Great. Now update the system of record that's going to be slow and expensive, etc., and make sure that we've agreed that that's the official record. So you've kind of got a fast think and a slow think set of systems working in tandem, one of which optimizes for that security, the longevity, the guarantee, the other of which optimizes for moving really, really, really quickly and really, really, really
And
cheaply.
this is the foundational piece, and this is what's changed for me. We've had the Bitcoin network, what is it, since 2009, runs at I think you said 7 transaction a second. You'd put in the letter, the Visa network, what is it, 60,000 transactions a second, orders of magnitude difference. What we've seen is the Lightning Network come along on top as a layer 2 on top of the Bitcoin network, and that for me has been the transformation. So maybe just spend a couple of seconds on the Lightning Network, because people will, if they have not tracked this space and kept up to date, they'll maybe have heard the rhetoric in the both blockchain and Ethereum space that these networks are slow and can't handle the transaction volumes you need for something like the credit card networks. What's changed here with the Lightning Network as a layer 2?
So it's critical. The Bitcoin network is still slow and still expensive, and that's a good thing. It's exactly the same reason it's secure. It's the same this because you optimize for security, you've also made it slow. That's a good thing. But when you want to say transact quickly, you want to handle the millions of transactions happening at merchants every minute of every day, you need a different system. So the way the Lightning Network works, it's one of these tag along layer twos, but it's specific to Bitcoin. The Lightning Network, two parties lock up a bundle of Bitcoin on the Bitcoin network. It's a contract where they each have a signature and neither one can move funds unless both agree to move the funds. That then allows them to move transactions off the network into the layer two. They're now can issue and counter issue claims on the Bitcoin they've locked up in the network. So they're basically just exchanging IOUs that says, hey, we locked up 10, we each put in 5. All right, I'm going to give you an IOU for one of them, or I'll send you back 2 of them. I'll send you back a half of them. And they can do this as many times as they want. They can then send those IOUs to other people. They can prove, hey, I own 5 of the Bitcoin in that contract. I've got IOU from that guy over there for one of them. You're good for that. I'm gonna send you that IOU. You can know it's good because you can cryptographically prove, you can trace the data all the way back to that Bitcoin. And you know when you hold that IOU, you can actually redeem the underlying Bitcoin. So we can bounce all that stuff
So
around.
you could do a bunch of transactions between Walmart and Amazon and this network and various people and move money around like you would on a credit card. And then at the end of the day, collect all of those transactions together, drop them onto the actual layer one blockchain or it's underneath the inherent in the Bitcoin network and have it become a block in the in the chain there on the Bitcoin network, and then go again the next day. What you might have had in that intraday block is thousands of transactions, but all you've done at the end of the day is add one block to the chain, therefore one blockchain transaction in the block in the Bitcoin network. Am I thinking about that in the right way?
You've got it exactly right, and the term I would use, you're net settling the aggregation of all of those gazillions of transactions that happened. So lots can bounce around, but net only half a Bitcoin move between the parties. That's how much settles. Now, let's be clear, those IOUs you're issuing, yes, they're claims against 5 Bitcoin, but you can issue those IOUs in any currency you want. Hell, you could price them in widgets and henways. It doesn't matter. All that matters is that there's a party issuing that IOU that says, this is the exchange rate, your widget for per Bitcoin. And I'll guarantee cryptographically that when you send in that IOU, you net settle out the actual underlying. At that point, you can have dollars, it's the system can be extended as far as you
So
want.
this is what we're talking about here, this foundational layer and layer one and layer two that is analogous to the network. Talk to me then a little bit about what Strike are doing.
Let me back up because you made a really good point there. When we're bouncing around claims in the Visa network, quite literally what you're bouncing around are claims on dollars held in bank accounts. It's very similar to this Bitcoin Lightning Network. Money isn't physically moving through the Visa network. What you're moving through when I swipe my credit card, there's a message that goes from the merchant through the payment processor through the Visa network over to my bank. And my bank goes, yeah, Jared's got money in his bank account. Great. Then it comes all the way back. And they say, look, Jared's got money and bank has guaranteed that merchant, when you send that IOU to us, we will make sure you get paid. And they go, great. And they store that IOU. 3 days after I pay you, you see those payment processing things in or pending payments in your credit card bill. Those are things where you've swiped your card. The bank said, sure, we're going to pay, but the merchant hasn't actually turned in that IOU yet. 3 days after I pay for the coffee, the merchant turns in the last 3 days, a whole bundle of IOUs, and they get sent back to the Visa network in a separate transaction. They fire off to all of the banks from all of the credit cards that were issued, and all those banks go, yep, we recognize those IOUs. We said we would pay. Tell us who your bank is, and we'll route the money to that bank. We're just bouncing around IOUs, claims on money stored. The Bitcoin Lightning Network is doing the exact same thing. It's routing around IOUs instead of on a bank account, an underlying Bitcoin that's locked on the Bitcoin network.
So now we understand the foundational tech. We've positioned the layer one and layer two. Talk to me about one of my favorite people, what Jack Mallers and the team at Strike are doing. As I say, listeners, if you've not seen an interview from Jack Mallers' closet on one of the major TV networks, it is comedy TV at its best. And if this guy wasn't as wicked smart as he obviously is, he would have a credibility problem because he's normally on CNN or Fox or one of the channels wearing a baseball cap coming from an empty closet. But the guy is whip crack smart and he is disrupting a multi-billion-dollar industry. So tell us a little bit more about Strike and what Jack is doing over there.
So Strike, like the Bitcoin network, this Bitcoin layer two, the Lightning Network. The Lightning Network is open sourced. It's being developed by, for lack of a better term, volunteers who are committing their time to go build this. Strike is a for profit company, a money services business that's built on top of the Lightning Network to make it easy for traditional payment processors like Square or merchants like Walmart or digital payment processors like Apple Pay to go integrate the Lightning Network into their services. So in that sense, Lightning is sitting in between the same way Square sits in between a merchant and the Visa network. Strike is playing a similar role where it's sitting in between the merchant, actually the payment processor, because you need another layer, and then the Lightning Network. They are fundamentally, they're making it easy for anyone to hook up to the Lightning Network and move money around. And what's critical here, they cannot and nobody cannot take on the world at once. My Joe's Coffee is not going to go buy a service from Strike. They're trying to run a coffee shop. They hate paying the credit card fees, but at the end of the day, that's not the business they're in. They're not in the business of adopting new technology. Instead, they've got a terminal there, a Square or a Toast or whatever, that big heavy thing where you swipe your card and you go, fine. Well, that's where Strike needs to go integrate. They need to go call up the payment processors, the Squares, the Toasts, whatever, and say, hey, what if instead of when you collect your 10 cents plus 2.5% from the merchant and you're sending 10 cents plus 2% to Visa, you're only keeping 0.5% for yourself. What if instead we hooked you up to this new network? You, Mr. Payment Processor, who has tens of thousands of merchants, what if we hooked you up to a new payment network and you can cut the fees for that merchant down to 1%? You're going to keep 75 basis points. You're going to pay us 25.
It'd be really
That's you would cut the fees in half for the merchant. You would almost double the fees for the payment processor. It's the economics are absolutely awesome here.
it'd be really interesting if Square would have changed their corporate name and their CEO would have given up half of his responsibilities and been really crypto focused. It would be really interesting if that was the dynamic.
You know, it'd be a good name for the company. They should call it
I
Block,
think it's
like blockchain. They should
blockchain
call it
based. I
Block.
mean, somebody get us a contract to do the naming rights for Square. I think we ought to change. Oh no, it is called Block, and it is and it is now run by Jack Dorsey solely, whose Twitter ID has one word in it: Bitcoin. This is the level of disruption that is going on in the space. Jack Mauler sees it. Jack Dorsey sees it. We're just shining a light on it here, I think. This is the foundational layer. And this, for me, is interesting when we talk about the metaverse. You'll have heard the metaverse. You'll have heard all this sort of getting press coverage and everybody rolling their eyes that VR glasses aren't going to work. For me, this is the foundational disruption. If the first version of the web and even Web 2.0 was payments as a rail done on credit card, you use Amazon, you connect it up to your PayPal account or you connect it up to your Visa card. This is Web 3. This is the metaverse. This is where I see it going.
Yeah, and it just this has to happen through partnerships. The merchants aren't going to switch over to a new system. We certainly aren't going to give up our credit cards. What you need is you need to get this network embedded under the covers with the payment processors to make the shift happen. And that is exactly what we're seeing. Just in the last couple weeks, I mean, the headlines are now hitting hard and fast. Apple Pay announced a partnership with MetaMask, the largest crypto wallet. Shopify announced a partnership with Coinbase Commerce, so anybody on Shopify can pay with crypto, including US dollar coin, a digital dollar equivalent. Shopify's CEO is now also on Coinbase's board. Shopify announced another partnership with Strike, so anybody can go accept your Bitcoin Lightning Network payments for practically nothing. Strike signed a partnership with NCR, one of the largest point of sale merchants in the point of sale companies in the world. They're when you go to Wendy's, that's NCR under the covers. I mean, this is hard and fast. And yes, this is going to take time to roll out and so on. But we are watching the foundations of a new payment network every single day, another announcement coming out. Somebody else is setting up to move over to this new
And we're
network.
seeing
And
it
that
the other
is
way.
wildly transformative
We're
for the
seeing it the
industry.
other way. We saw Trace get bought by Mastercard recently. Trace, if you don't know what they do, is they're one of the probably 3 or 4 companies that do blockchain analysis. They're the people who can tell whether something's been where the money's gone in a ransomware attack, for instance, if they've used cryptocurrency, or they can trace and work with governments and trace illicit funds. Recently bought by Mastercard. So it's not just crypto disrupting one way. The Visa and Mastercard are run by smart people who see the same trend. They're coming back the other way.
And Visa got way out ahead of this. They stood up a crypto team a number of years ago. It's a strong team doing interesting work. I don't expect, and I'm not going to pick winners here. I don't expect all of the credit card networks to survive. This is going to be a massive shift. But many of the services that they sell today, the fraud prevention, making sure it's actually you paying for the thing, the anti-money laundering, the know your customer, there's a whole series of frankly super valuable services that they offer that don't exist on top of the Lightning Network yet. Visa, Mastercard, Amex, Discover are well set up to offer those very same services on top of a competing network. And I expect some of them will successfully make that shift and find new ones to offer. The ones who I think have the most interesting opportunity in front of them are the payment processors. Historically, they've taken huge top line revenue. Yeah, I get 2.5% or whatever of every transaction, but then they're sending all of that over to Visa, to Mastercard, whatever. So their net revenues is actually fairly small by comparison. They have a massive incentive to shift over. But for the very same reason, because it's an open network anyone can build on, it's likely we're going to see massive competition that's going to drive those fees practically to zero overnight. So while they will short term be the beneficiary, what is called wholesale transfer pricing, the merchants eventually are going to be the beneficiary here. They're just going to drive that down to zero. They're going to end up with more profit, nothing left over for the payment processor. But we do know how they make money. If you go look at what Square is doing, go look at what Strike is doing, look at what some of these innovative companies are doing, they have daily insights into the cash flows of Joe's coffee shop. They know what their inventory is. The ability to go offer loans for inventory, loans to meet payroll, payroll processing, all of the basically to be the operating system for that store for all of its financial services and then simply to give payments away for free is the entree to all that set of services. That moves the payment processors into a space that, frankly, is a lot more akin to the banks, the way they issue cards today. Banks are happy to underwrite our 2% cash back and all of our fun points because they make silly amounts of money when we don't pay off our bill every 30 days and they lend us money at very high rates. So they give away the card for free, actually often at a loss, in return for making up on loan volume and the profits that come with it. The payment processors have better insights into the finances of every single merchant that they serve than anybody else in the world. They are phenomenally well positioned to offer these higher end lending type products to the merchants and make way more money than they ever have. And yes, payments will have to go for free because it's the entree price to
It's
get
also
that
that
data.
analytics. They've got the time the transaction happened, the amount the transaction happened, what was on the list, what was on the description of the transaction, who did it. That is vital data to everybody downstream who wants to drive more transactions of that type through the network, wants to understand where I buy my coffee in the morning, how much I spend on my coffee. That and it might be anonymized and provided downstream in the aggregate. So people, my age who look like me, who live in my town, might be the data set. But the ability to provide that downstream as an aggregated analytics feed there's money to be made downstream. So, yes, as you say, they might not be making it as the payments provider, but there's certainly a whole bunch of money that can be made by being right at the point of impact of where that transaction happened.
Couldn't agree more.
So, with a couple of minutes over, as we always are, what does this mean? Wrap us up here. Get us out. What does this mean going forward? What do you see?
So it's going to be a massive shift for the card networks. Some will make it, some won't. They certainly have very valuable services that even if the network fees go to zero or practically zero, that they are well positioned to be successful. But it's a huge shift for them. Payment processors, similarly, their primary revenue stream, if this open network shift is successful, which I expect it will over called a decades long time period, that's going to be a big revenue loss for them. But the opportunity to make new types of revenue is so much greater than what they're giving up that for those that make the transition, I expect it to be wildly successful. And we will mint the next type of Square or Strike or what Stripe or what have you. For you and me, for our listeners who go and swipe our cards, frankly, I expect life to be exactly the same, and that's exactly the point here. I don't want my life to change. I want to keep going into the store and tapping my phone or swiping my card or what have you and paying for my stuff. And I don't really want to have to care what happens under the covers. And what's so awesome about this revolution is we won't. We just go on with our days. The merchant makes more money. They get a new set of financial services offered to them by the payment processor, and life goes on. I mean, that is exactly what success looks like. And it's going to be absolutely awesome as it happens.
Disruption with minimal impact, if nothing, to the consumer. What a great way to describe it. You've been listening to the Fat Town Thoughts podcast, brought to you by Jared and I every week, where we talk about the makings of money, finance, and crypto. We'll see you on the show next week. Thank you very much for listening.